we here to do?
We are here to talk about and this was actually a request video, so this is great. All right. We keep talking about contribution types. What does that mean? What are the contribution types? Who do they come from? Why are they different? All that other good stuff. Okay, this is Friday afternoon. We're on the couch, we're drinking a bourbon. This is our Friday afternoon on the couch bourbon edition. Catherine, how many different types of contributions do people care about?
4.
All right, and they are 3 of them come from?
Employees.
And 1 of them comes from?
The employer.
Oh, yeah.
Well, there's some subtypes in the employer.
Right. Well, we're going to list them. There's
traditional, Roth, ketchup, and employer.
And employer contributions. All right. Now then, what's a traditional contribution? What are people talking about?
Super basic. What people think of it with a 401k plan is that pre-tax money. That I'm making $80,000. I contribute $5,000. I bring down my income by $5,000.
Right. So the traditional, what most people think about, right? It's pre-tax. This is pre-tax for the employee. It reduces their state and/or federal withholding definitely, and if the state's got an income tax, it reduces that. It does not reduce payroll taxes, but that's a different video. Okay, now then, the other type is
Roth.
And this is relatively new, which is why we don't call it traditional. And Roth means
after tax.
All right.
Which means you do all of your taxes, your federal, state if applicable.
Right.
But
why is this a benefit?
Because then you don't pay taxes again.
On the gain. If you take the money out after you're 59 and a half, if it's been in there at least 5 years, you take the gain out tax free. The difference with traditional is that you are deferring your income tax and you take it out later. With a Roth, it's tax free. And so this works out really good for young people.
And how I like to say it is you settled your taxes at the beginning.
Right, okay.
Because you did pay some tax.
Now then, there's another type that can be either traditional or Roth, and that is a
ketchup.
Ketchup, okay, not
which is
ketchup.
not a condiment.
No.
So
you don't put it on a hot dog.
So what's the theory? The theory is that you didn't put away as much as you should have
at the beginning. So the idea is that if you're 50 or older, all right, so if you're born, this is being filmed in 2023 or videotaped in 2023. So if you're born at any point in 1973 or before, you can defer an extra amount. It's $7,500 this year. You do not have to wait until you're actually 50, all right? If you turn 50 on December 31st, you can contribute the entire amount earlier in the year. You don't have to wait until you're actually 50. It's the calendar year you turn 50. It's more money. It's more money for us old folks. Okay? Yep. Now then, what's the other really big contribution type?
Well, employer. And there's some subsets in it.
Definitely, there's a bunch of subsets in there. Right.
So there's profit sharing, there's safe harbor, there's
match,
there's additional because discretionary, just because you're trying to pass testing.
Right.
All sorts of fun little employer
But the important thing is this comes from the employer. This kind of contribution is always pre-tax because it's a deductible contribution from the employer. Yeah, I know there's this little provision in Secure 2.0. We're not going to talk about that here, all right? But for the most part, when an employer is making a contribution to the plan, it's a deductible contribution for the employer, and it counts as pre-tax money for the employee in their plan. And so that means that when you take your money out, your tax on the gain is deferred, all right?
For the sake of clarity, can I ask a question?
Yes, absolutely.
We have a peanut gallery. What's the question?
I know Roths can be confusing to people, and I get that. They don't necessarily fully understand the Roth IRA, the Roth 401k. They don't get it. For an example, I put $10,000 in my 401k plan.
Yes.
I, by the magic of interest, got up to $30,000.
Yes.
Yeah.
When I start to pull money out at age, millions of years old, because I'm never going to get to retire, I'm not getting taxed on any of it, correct?
None of it. Correct.
Not even the $20,000 I made.
And that's the whole point.
That's
exactly.
That's the point of Roth.
Free.
Do you know how many people don't understand that?
It's
so
that's why we do videos, babe.
So the after discussion.
You need to always record the after discussion.
I'm here for it.
So Zach, the question too, when you say both, some financial advisors will say it's good to have both. Because when you're retired, you can make a decision in that year, do I need it pre-tax or do I need it after tax? Say you had like a lot of money coming in one year, you're retired and you're gonna have a lot of money coming in, but you still have to take an RMD. You can choose what bucket you want it to come out of, and so you're giving yourself flexibility in taxes is basically.
You asked us like, how do you choose which one's which? Well, that depends on your personal tax situation, but the general consensus is the younger somebody is, the more years they have to retirement, the more likely they should be doing Roth, all right? The other consideration is there's this concept, I didn't make it up, there's this concept of tax diversification, all right? If most of your money, okay, is in pre-tax, well, everybody knows about, or hopefully most people know about diversifying your investments, all right? You should not have all your money in Ford Motor Company or all your money in Microsoft or anything like that. You're supposed to diversify your investments. Well, the same concept is true with tax diversification, where if most of your investments are in pre-tax money, maybe you should consider having some of your employee deferral be Roth, so that you are diversifying your tax strategy. All right, so thank you very much for watching. Please like, subscribe, comment, ask questions. That's why we're doing this video. If you'd like to contact us to ask a specific question, it's sales@hunterbenefits.com. Take care.
Toodaloo.